Okay, so let's talk about what's going on with global fund managers and their view of the US stock market. It seems like they're getting all of it spooked, and they're starting to favor cash over equities. Big names like Warren Buffett are holding record levels of cash. Right now, we're talking $334 billion in cash. So that's a pretty significant indicator that things might be changing. Analysts at Bank of America are even calling this a bull crash in investor sentiment. Seems pretty dramatic, right? But some experts like Michael Hartnett, who leads the analyst team over at Bullfast, suggest that this could actually be a good thing. A correction of this magnitude could be setting the stage for a more stable market down the road. A huge factor in all this is declining investor optimism, especially as we head towards a potential second term for Donald Trump. Bullfast's monthly global fund manager survey from March paints a pretty clear picture of this downtrend in sentiment. And it's not just a feeling, there are some concrete numbers backing it up. We saw the second largest drop on record in global growth expectations. And get this, the allocation to U.S. equities saw the biggest decrease since Buffett began tracking this data all the way back in 1994. So this is a pretty big deal. And it's not just a wait-and-see approach. These fund managers are actively selling off stocks to increase their cash reserves. They're behaving a lot like Warren Buffett remembered his famous advice to be fearful when others are greedy and greedy when others are fearful. It seems like that's exactly what's happening right now. Now, this bull crash, as they're calling it, definitely represents a big shift in sentiment, but the BofA analysts believe the speed and scale of that might actually be a healthy correction for the market in the long run. Keep in mind, we're talking about 171 fund managers here, managing around $425 billion in assets. So this isn't just a few people getting nervous, this is a significant portion of the market. One of their main concerns seems to be the uncertainty surrounding Trump's tariff policies. This back and forth on tariffs is making it really hard to predict what's going to happen with U.S. trade, and that's making investors really nervous. This uncertainty about global trade is reflected in the outlook for the global economy. The percentage of investors expecting a weaker global economy in the next 12 months absolutely skyrocketed. It went from a tiny 2% in February to a whopping 44% in March. That's the largest monthly drop in growth expectation since March 2020, the start of the pandemic here in the US. So yeah, people are getting a little worried. It's interesting to see how closely tied fund managers' sentiment is to the performance of the S&P 500. BofA noticed this, and after releasing their survey results, they made a pretty straightforward comment. They said, pessimism on global growth outlook is bad news for stocks. And it makes sense, right? If investors are worried about the economy, they're less likely to invest in stocks. Remember the stock market rally after Trump's election win back in November? A lot of that was fueled by hopes for tax cuts and deregulation, but that initial optimism has faded as Trump has focused more and more on using tariffs to address the U.S. trade deficit. This unpredictable approach to trade policy has left investors feeling uncertain and hesitant, and the survey results really reflect that. 55% of fund managers identified a trade war-induced recession as the biggest threat to the market right now. That's the highest level of concern we've seen since April 2020, when the big worry was a resurgence of COVID. So trade wars are a major source of anxiety right now. Right behind that are concerns about inflation leading to interest rate hikes by the Federal Reserve. And this one may surprise you, but a significant number of fund managers are also worried about Elon Musk's Department of Government Efficiency, or DOGE. Yeah, it seems like DOGE is causing some real concern in the financial world. It's not just recessions and trade wars that are on people's minds, though. Over 70% of those surveyed anticipate stagflation, a situation with slow economic growth and high inflation. Now, despite all this talk of recession risks and stagflation, not a single fund manager in the survey predicted an outright recession. So maybe there's a sliver of optimism hiding in there somewhere. It's worth remembering that these investor sentiment surveys are better at explaining why stocks have gone down recently than predicting what's going to happen in the future. But still, the data does show us a clear trend among these big investors. They're moving away from stocks and toward cash. In fact, the average cash position held by fund managers in the survey jumped by 60 basis points in just 1 month, hitting 4.1%. To give you some context, 60 basis points is equal to 0.6%. So this increase in cash holdings is a pretty big deal. And it actually signals the end of BofA's contrarian sell signal. What does that mean? Well, BofA's sell signal is kind of like a reverse indicator. It suggests that when a lot of investors are selling, it might actually be a good time to buy, and vice versa. When everyone's buying, it might be time to sell. This sell signal was initially triggered back in December when fund managers' average cash holdings dropped below 4%, BofA's threshold. And what happened? Both the Nasdaq Composite and the S&P 500 entered correction territory, falling by 10% or more. Now they have recovered a bit, but it's interesting to see how that sell signal played out. There's no doubt that fund managers are making a deliberate move away from U.S. stocks. stocks. Right now, and that 23% of investors are underweight in U.S. equities. That means they're holding a smaller proportion of U.S. stocks in their portfolios compared to the benchmark. This is a huge shift from the previous month where a net 17% were overweight, meaning they held more U.S. stocks than their benchmark. This 40-point swing is the biggest they've ever seen in the survey's history. It really shows how much sentiment has changed. And get this, 69% of the fund managers surveyed believe that the idea of U.S. exceptionalism, the belief that American stocks will always outperform the rest of the world, has reached its peak. Meanwhile, there's growing optimism about the Chinese economy, so it seems like the global investment landscape is undergoing some pretty significant changes. Now, even with this move away from U.S. stocks, the both face survey shows that investors are still fairly confident that the Federal Reserve will be able to achieve a soft landing. What's a soft landing? It means bringing inflation under control without causing a recession. And they're also expecting the Fed to cut interest rates to its times this year. So there's some hope that the Fed can manage things smoothly. On a positive note, the S&P 500 had its first positive week in a month. That's not a huge win, but it's a sign that things might be stabilizing up there. This uptick in the market followed reports that the reciprocal tariffs that Trump had planned on implementing on almost all U.S. trading partners would be announced with a smaller scope than originally anticipated. The market seemed to breathe a sigh of relief at this news, and the S&P 500 rose by 1.5% on the Monday afternoon after the reports came out. So maybe there's a glimmer of hope that the trade war fears will subside, but one thing's for sure, the speed at which investor sentiment has changed is remarkable. Botha's Global Fund Manager Survey really highlights this. In just 4 weeks, fund managers have reduced their U.S. stock allocations by the largest amount in the survey's 24-year history. It's pretty incredible when you think about it. The overall mood is definitely pessimistic right now. 63% of money managers expect the global economy to weaken in the coming year. So the big question is, where do we go from here? Well, Botha actually argues that this widespread pessimism could be a good thing for the market. Why? Because so many fund managers have already sold their stocks and built up their cash reserves. Eventually, they'll need to reinvest that cash and push the market upward. The big unknown is when this reinvestment will happen. And with all the uncertainty around Trump's global policies, it's hard to say when investors will feel confident enough to jump back into the market. So we're in a bit of a holding pattern right now. There's a definite trend of investors searching for safe havens to protect their money from the uncertainty coming out of Washington. The problem is the traditional safe havens are getting crowded. For example, the price of gold has skyrocketed to record levels above $3,000 an ounce. Historically speaking, gold is looking pretty expensive right now, and bonds, another typical safe haven, are also facing challenges. Trump's focus on tariffs is a big concern for bond investors. Tariffs could disrupt global trade and potentially lead to inflation, which is bad news for bond places. So even the usual safe havens aren't looking as appealing as they once were. Now, some investors might be looking at assets that could benefit from Trump's policies, but early indicators like Bitcoin and Tesla haven't exactly been stellar performers since Trump took office. Bitcoin has been steadily declining, and Tesla stock has lost over 40% of its value. This is despite what seems like a positive relationship between Trump and Elon Musk. So it's not clear which assets will benefit most from the current political climate. With all this market turbulence, there are 3 areas that are being considered as potential havens for investors seeking a bit more stability: Berkshire Hathaway, European stocks, and Canadian electrical utilities. Let's take a closer look at each of these. Berkshire Hathaway, led by the legendary Warren Buffett, has a remarkable track record. Their stock price has tripled in the last 5 years, which is a pretty impressive feat. And they're sitting on that mountain of cash we talked about, $334 billion accumulated from steadily selling stocks over the past 2 years. This gives them a lot of flexibility to seize buying opportunities that might emerge from market disruptions. And even though Warren Buffett is 94 years old, the team at Berkshire is incredibly experienced and well-established. This means that the company can handle the current market volatility with a relatively low level of risk. Berkshire stock has actually climbed over 12% since Trump's inauguration. The diversification, massive cash reserves, and strong management teams suggest that they can continue to perform well even if the market gets choppy. European stocks are also drawing attention as a potential haven that are less directly affected by Trump's policies, and their valuations are significantly lower than U.S. stocks based on metrics like price to sales, price to earnings, and price to book ratios. Europe does have its own economic challenges, of course, things like an aging population, a smaller number of big tech companies, and complex political landscapes. But the good news is that expectations for European stocks are relatively low, so it might not take a lot of positive news to surprise investors and drive prices higher. Goldman Sachs has even said that European stock markets started the year strong and could potentially rise by another 6% throughout the rest of the year. That's pretty optimistic. Germany's recent decision to increase government spending could also stimulate industrial growth in Europe. And as Europe ramps up military spending in response to the situation with Russia, that could also provide side of this to the economy. So there are some potential tailwinds for European stocks. If you're interested in investing in European stocks, there are some low-cost exchange-traded funds or ETFs available from companies like Vanguard Canada and RBC iShares. These ETFs target either Europe specifically or broader non-North American markets, so they're a convenient way to get exposure to European equities. Finally, let's talk about Canadian electrical utilities. Companies like Canadian Utilities Ltd., Fortis Inc., and Hydro One Ltd. offer a nice mix of reliable dividends, reasonable stock valuations, and decent growth potential. And here's a big plus in the current environment. Their business is relatively insulated from potential slowdowns in consumer spending that could result from trade wars. That makes them particularly attractive to investors who are worried about the economic impact of tariffs. Now, the utilities might not deliver the kind of eye-popping returns that some investors are looking for, but they do offer the potential for steady, consistent growth. And in times of market turbulence, that can be a very valuable thing. So to wrap up, global fund managers are sending a clear message with their actions. They're worried about the current market conditions and the potential impact of future policy changes, especially those related to trade. This has led them to reduce their U.S. stock holdings and increase their cash positions, a move that reflects a significant shift in investor sentiment. While this pessimism might seem concerning, some analysts believe that it could actually set the stage for a market rebound down the line. For investors who are looking for a bit of stability in these uncertain times, exploring alternative investment areas like Berkshire Hathaway, European stocks, and Canadian electrical utilities might be a good strategy. These options offer diversification, reasonable valuations, and the potential for decent returns, even if the market continues to experience volatility. As we've seen, the current financial landscape is incredibly complex. The contrasting views of cautious fund managers hoarding cash and analysts predicting a potential market upside highlight the challenges of navigating this environment. Geopolitical factors, particularly trade policies, are having a major influence on investor sentiment and market activity. It's still too early to say how these trends will play out in the long run, but it's clear that investors need to be prepared for a potentially bumpy ride. Now, before we wrap up, if you're enjoying this analysis, please take a moment to like and subscribe to our channel. It really helps us out, and it ensures that you won't miss any of our future deep dives into the financial world. Thanks for listening, and we'll see you next time.